JJ, the CPA is here.
JJ, the CPA here. Hope you're doing well. I love it. Some of you have said, hey, where's the video when you're driving into work? Today is deadline day. It is the day that you have to file your return or file an extension. This is on the individual side. And if you don't pay your taxes by today, you're going to start to incur penalties. Now, I'm going to date this video July 15th, 2020, because I'm going to make a few well-educated guesses, predictions, and this will be part of my planning with my own clients. So these aren't predictions just for the jollies of it, but it is to let you know how I'm moving forward with my clients. So, a number of things. Number one, I do feel like within 2 weeks, the Internal Revenue Service will, in essence, say, well, if you weren't able to pay your taxes by July 15th, we will lower the penalties. And for those that know the calculations of that, I think what they'll do is lower the safe harbor as it relates to the amount of time that you have to pay taxes for 19. I don't believe they'll remove any underpayment penalties, which is penalties you would have already incurred for not paying in enough tax throughout 2019. Right now, there's a 90% threshold, meaning if you pay your taxes within 90% of the actual by the due date, there's no penalty. Hang on a second. I think they'll lower that down to like 50%. I don't think it'll be as generous as it could be, but I do think though Congress and or the president with executive order will indicate that the entire nation is under, in essence, a disaster, and instruct the IRS to follow the disaster rules, which is this. You have until October 15th to file and pay your taxes without any penalties. So I think that'll be the ultimate result, which might take 3 to 4 weeks for us to know that. Nonetheless, I'm not acting on any of that with my clients, other than just I'm preparing that that'll be probably the case with the clients that haven't paid. It gives a little more time. I do feel like with the EIDL, it's going to probably end within a couple of weeks. I know that there are dollars that it can loan out. The SBA is. I do feel like that, that's been up to $2 million. It lowered to $150,000. I do think that will come to an end. Congress will have to do something more specific, which also means when Congress comes back into play, I think in early August, that the EIDL will get half the funding that will be left over from the Paycheck Protection Program. We keep hearing that there's still $130 billion available. So let's just say that it's $100 billion that's available by the time we hit August 8th, which is the extended date to get PPP if you hadn't already. So let's just say there's $100 billion there. Well, I wouldn't be surprised if $50 billion went to the SBA. They've been very efficient, impressive in getting relief out there. I think that what will continue is, in essence, this $150,000 cap of what's being provided to businesses that qualify for the EIDL. I do think, though, out of the EIDL, there'll be a lower threshold that's going to be made available similar to the grant. It may be still the $10,000. It used to be, it was just 10 grand, not $1,000 per employee. So I think it will go back to that. And therefore, if you didn't get the grant up to $10,000, my thought is that in August, we would be able to apply for the grant, and I think the grant only. Right now, to get this grant, the Economic Injury Disaster Grant, you have to apply for the EIDL. So it may even be that they have a separate portal, but because the EIDG was always just a flat 10 grand in the past, I think it'll go back to that. And then for those that didn't get the full 10 grand, it will be made available for the difference. As it relates to the Paycheck Protection Program, I'm predicting that they'll have to rename it or make it obvious that it's a different kind of Paycheck Protection Program. But I think it won't be much of a paycheck protection program, because it was for small businesses protecting the paycheck of its employees. Well, the employees have the PUA. PUA is up and running, and those that qualify are getting it, including the self-employed, the gig workers, etc. So they'll continue to provide that because they had separate funding available for that. It's available up to 39 weeks. It's available 13 weeks longer than the state. So that's all PUA, PUA being the Pandemic Unemployment Assistance, which you get only from your state unemployment office. At some point, PPP is run out for everyone in the sense of you got it, you spent it. Now, I know there's lots of questions. If I'm self-employed, do I get PUA and this and that? I mean, all I can say is with certainty, in my opinion, after you get PPP, the first 8 weeks, who knows, it depends on your state, but after 8 weeks of having PPP, you're gonna, in my opinion, qualify for PUA, because PPP was only meant to be for an 8-week cover. So my point is that with the PPP, this $100 billion that might be left over, half of it may be going to the SBA for what I just indicated. I think the other half will go to small businesses, the $50 billion, but it won't go for paycheck protection. I don't think it really was as successful as they had thought or hoped. I think they had a lot of doubling up of benefits for employees. And all I'm saying is the employees got PUA, and then employers got money to pay employees. But quite frankly, to the employees, the majority of employees would have actually received more on PUA. So all I'm saying is PUA is a better deal for employees. Now, if you're highly compensated, I understand that it's not. But with the PPP, and now let's say we're working with 50 billion here, I think it'll be targeted towards specific industries. If you remember when the EIDL came back online in June, at first and for several weeks, it was only available for those that were in the agricultural industry. So I think that it will then be that the EIDL will also be potentially for a segmented industry. But maybe not. But I think on PPP, it'll be segmented, and also only to very specifically small employers. This is really a clear indicator, not from my prediction, but my prediction based on what the Senate was talking about when they were considering the advance of, it's the 15th, so I got to keep rolling. When they were considering the advance of, not the advance, the extension of the PPP, the Senate was wanting to make it available to employers that even already received PPP, and the limitations they put on that was that it would be less than 100 employees size business with same affiliation rules. And I think there was a limit to it. Might have even been the 150,000. The reason I think that that's pretty realistic is the 150,000 or less for PPP, and for 100 or less employees, is that when you look at the employee retention credit, that's available only for employers that are 100 or less employees. And then on the 150,000, that is what the SBA has pretty well limited its benefit amount to, is the 150,000. So I think those two combinations, we're hearing a lot about the restaurant industry, the barbershops and salons and nail shops, the personal hygiene type services, as well as gyms, workout centers. We know we have two businesses, and really three that fall into this that we're working with on our reality show. One's a dance studio, one's a barbecue restaurant, and the other is a pedal spin studio, spin classes. We have 5 locations in California that just shut down. So those are the ones that are being hit hard. I think the ones that will not be included in the opportunity for relief will be those in the accounting or legal or medical field. I think even if you're in the medical field, maybe where you get shut down, I don't know that it will be available, because those that would get shut down most likely are the non-essential medical. Not saying it's not important, but the non-essential medical. I also think, just moving into the tax a little bit, in terms of some predictions, that I'll wrap this up, that we are going to see next year the capital gain treatment of qualified dividends will go away. I think that dividends will be taxed at ordinary tax rates. Interest income is taxed at ordinary tax rates. Right now, qualified dividends are taxed at the capital gain rate, which is a 0, a 15, or a 20%. I think that the sale of assets will see an increase, meaning I think the capital gain rate will no longer be a 0 or a 15. I think the capital gain rate will be 20%. I believe that the 3.8% Medicare tax that is added on to wages and investment income above $250,000 will either be, the threshold will be lowered of what income is subject to that, and or the rate will go up. Well, I think what's more likely is that it will be, maybe on the after 150,000 of income that comes into play. I think that the Social Security tax, I don't think that the 7.65% or 15.3% for the employers will change. I know that it goes up by 0.9 for this additional Medicare tax. So I think that still will be in play the same way. But what I'm saying is, on the Social Security wages, meaning the wages or self-employment income that's subject to Social Security taxes, the 6.2% for the employee, the 6.2% for the employer. Right now, you don't pay that tax on wages and or self-employment income above $137,700 per employee, per self-employed individual. Now, that number changes every year with inflation. I think that that'll go up dramatically as a way to get more Social Security taxes, and there won't be a lot of political fallout on that, because it right now will be on the highly compensated. So I think there's going to be more payroll taxes, not necessarily more of a rate, but more tax that it would be coming in, because there would be more wages subject to the tax. So if you have a business where all of your employers make less than $137,700, you wouldn't see any change here. If you have highly compensated payroll employees, then you will. And that's why I don't think there'll be any political fallout. I also think that the states will be increasing their rates their income tax rates, typically, I'd say across the board, probably 1%. I feel like with the estate lifetime exemption, which is well over 11 million per person, that's a lifetime exclusion. That's been on the chopping block for a while, and right now it's set to expire on 12/31/25, meaning it'd go back down to the 5 million. I think that will expire sooner. It might even expire in 12/31/21. Again, not much political fallout on that because that's just a tax on what? The rich. Now, I think, minor politics. I do feel like if a Democrat gets into the White House, we'll see things fall back to tax rates that historically have been when Democrats are in office. They have been this when Republicans are in office. All I'm saying is I think they'll fall back. Well, right now we have a tax rate of 37%. I think it would go back to the 39.6% top tax rate. The corporate rate's 21%. I think it'll stay a flat tax rate, but I think that'll go up to probably 24%, maybe 25, or at least another level. It used to be, up to 35%. So even though they have a flat rate, I think that they could still have a 21% just to save face, but then after a certain level, it goes up to 24, maybe 25%. And that corporate level of tax is on those that are not flow-through entities. So I think that there's going to be more taxes. I also feel like there's been talk of this for a long time about doing some kind of tax assessment on the earnings inside 401ks. It's been played with a lot. I don't know how that'll really come about. I know that when money's pulled from retirement, it's subject to ordinary taxes, even though it may have had a bunch of capital gains in there. So it seems like it would need to even itself out. But more what I'm getting at is I think that there'll be less that can be put into pre-tax retirement. I think that's really where the rubber will meet the road, is that probably the IRAs will be the same because it's $6,000, $6,500. That's not a lot. I think the defined benefit plans, the single Ks, the SEPs, I think those things will lower down on how much money can be put in and getting a tax deduction for it. So I think that's where there'll be less opportunity for savings. So as a summary, I think there's going to be more tax related to payroll. I think that capital gain rates will not be subject or applied to qualified dividends. I think that the capital gain rate will just go to 20%. I think that the Medicare tax will remain, but be subject to income sooner. And then as it relates to the states, I think we'll see a rate increase. And then as we are, looking towards estate planning, there'll be less of an exemption, and it'll just go back to what it was. It'll just go back to what it was sooner. I also see the qualified business income deduction going away. That'd probably be my biggest prediction here, is that it's creating a lot of compliance issues. I think the qualified business income deduction is great for my clients. It's fabulous, but it's not available really for those in the service industry after a threshold. So, I think that they'll either modify it or do away with it, or they'll clarify that it's not available to the real estate, or it's only available to these kind of entities, or only available up to this dollar amount. I just see that they're going to affect this qualified business income deduction, which is potentially up to 20% of the net income from your business, is not subject to income taxes because you get a deduction for that. As it relates to the excess business loss, we'll continue to see that. A limitation on the interest expense, we'll continue to see that. I know that that was removed for 18, 19, and 20, but those things are going to come back. NOL limitations are going to come back and remain. And I think we'll see that those that can have cash basis of accounting versus accrual up to 25 million, I think that threshold will get lowered back down. So more taxes, but that's how. I don't think it'll be really increase in rates other than maybe at the top. So anyways, those are my predictions for what's to come here in the near future. And then I think what we'll see next year, we have an election this year. So next year we'll be in a different environment somehow. And I think that the message here is cash is king. All right, hey, I got to get to it. Thank you for tuning in. I'd love it if you'd subscribe. And then don't you ever forget, you've never met a CPA quite like me. All right, hey, have a great day.